Welcome, everyone, to Investing with IBD podcast, sponsored this week by Direction. I'm Justin Nielsen, your host, and it's Wednesday, November 3rd, 2021. And I'm delighted to say that we have not one, but two O'Neill portfolio managers on the show today. O'Neill Global Advisors, a portfolio manager, Arusha Paris, is joining me as always. He is the Gilligan to my skipper and with me every week. But we also have this week, we might as well stick with that Gilligan theme and call him the professor. It's Charles Harris returning to the show. Charles Harris, welcome.
Thank you, Justin.
Yeah, and I should have just mentioned that, Charles Harris and I, we sat together probably 21 years ago. We shared a kind of space, which was a lot of fun for me to see him in action after he had a phenomenal 1999. I got to see him trading in 2000. And it was just a real pleasure to kind of learn from, someone who just had such a fine gauge on what was going on in the market, and just a really phenomenal performance too. So year after year.
Justin.
Yeah. So
those are fun times. We shared a cubicle together.
Yeah, right outside of Bill O'Neill's office. And then of course, Charles moved into Bill's office and with Mike Webster, and those were some fun times too. Nothing like getting Bill to giggle a little bit.
What did they do with you? Did you stay outside the office still at that time?
Yeah, I got to watch them laugh. It was cool. I would just be on the window kind of looking in like, wow, it looks fun in there. They let me inside every now and then, kind of like, when you let the dog in when it's raining outside. It was nice. Well, on today's show, we're going to go ahead and get into a little bit of what Charles calls flexibility, and this is not just for your workout style. This is being flexible in the market. He uses a lot of precedent, so he'll talk about being flexible with that when the precedent isn't working, and with the market itself. And as always, we're also going to talk about the market before that and a few stocks at the end of the show that are on Charles' radar. So let's get right into it and take a look at the NASDAQ composite, because really this has been a phenomenal run since our October 14th follow-through day. This is the 8th consecutive gain on the NASDAQ composite. So now the question is it too much? Is it extended? What do you think, Charles?
Yeah, so it has been a phenomenal run since we hit the lows in early October. And it does feel like it's getting a bit excessive just because, I'm feeling it in all of my accounts. So firm accounts, personal accounts, they're all at all-time highs. And it does feel like I might be making like too much. Sometimes you're like, am I, is like, you never want to kind of confuse genius with just a strong market.
Right.
So, you start to think like, oh my God, I'm really good at this. But really, we're just in a great environment, and our types of stocks are working really well. The O'Neill type, kind of the growthy stocks have been working. And so I'm a little nervous just because, it's been pretty much up day after day after day, but we're really just reversing a really bad September. So, we really haven't made that much progress from the highs that we hit in late August. So, so I'm still really constructive. I think that sentiment is improving, but it's not nearly at excessively bullish levels. So I think people have been very kind of reticent to get on board. And so I think eventually the market is going to pull everybody in. And then once that happens, things will truly be overbought, and we're going to likely, have some type of, pullback or correction. But, we're in a seasonally really strong period coming off of a, a seasonally weak period in September, early October. So, I'm trading, pretty aggressively, but I am selling into strength, which is what I do, looking to get back into some things on weakness. And I'm just, taking gains as they come to me. I'm trying to not be too aggressive on my selling because I do have a tendency to sell too early. And it is hard to reposition in if you're in a really strong market. Things will tend to go much further than you thought. So I'm really trying to kind of pace myself, but I am taking advantage of some of the strength and raising some cash. And so I'm on margin, but I'm not aggressively on margin. I mean, I have plenty of money to deploy. when we do get those opportunities. And I have done some of that in the last few days in some of the sectors that are really haven't been participating.
Charles, do you think that there might be a shift in now for most of the year, it was a pretty fierce rotation, and a lot of the commodity stocks, a lot of the real economy stocks were doing well. Do you think that maybe there's a shift back to more of the technology related growthy stocks that, you know, those are kind of more classic O'Neill stocks?
Yeah, absolutely. I mean, I think our types of stocks have been in favor now for the past, really even I think starting in like the July, August time period, there was a lot of strength in those sectors. And I was able to kind of get into the NVIDIAs and the AMDs and the CrowdStrikes and those types of stocks back. And I think it was in the July time period. And I think those stocks have pretty much been working ever since. And then you've had some of the kind of more reopening stocks, industrial stocks, you know, they seem to come on and then they come off quickly. So
Right.
I have actually, because those stocks have been coming off, I actually have been deploying some of my kind of, you know, winnings into some of those sectors that are down. Because that's just what I do, and hopefully they'll hold at, you know, some of the levels that I've pinpointed and start to rebound. But I think usually when you're in a, you know, the market's been strong, all the indices are at new highs, and I would expect there to be kind of some broad participation, not just amongst the growthier types of sectors that we specialize in, but kind of across the board. And I think you're starting to see that now also in the stocks that are benefiting from, you know, reopening and leisure. You know, we saw Lyft had a really good report and was up a lot today. Marriott at some point today was, I think, moving into new highs. Airbnb looks like it's setting up. So I think that, I think there's going to be lots of areas where you can potentially make some money.
So a lot of times, Charles, you take this contrarian view. I mean, you were on IBD Live at a point where a lot of us were, you know, talking about how nervous we were and stuff like that. And it was almost like you were making a tally on your clipboard saying, oh, look at how much bearishness there is, how much nervousness there is. And you were kind of taking the other side. You were saying, okay, this is making me more bullish, how nervous people are. And of course, you know, we shortly after that turned around. And now that we're seeing the strength, you're kind of looking at these areas where you might be getting into some things that are out of favor. So how do you distinguish between the stocks that, you know, are out of favor and it's just they're waiting their turn versus they're out of favor because they're laggard stocks and ones that you should be avoiding? The relative strength is worse, and they're out of favor for a reason. How do you make that determination?
Yeah, that's a great question, Justin. It's not easy, and I don't know that I always do it particularly well, but some of the, so first of all, going back to like last time I was on when I was kind of taking that contrary perspective, there really was a lot of bearishness.
Yeah.
You know, and there were so many kind of secondary indicators that were proving that. Sentiment has improved since then, but again, that's not nearly at excessive levels. But weakness in a growth stock is not necessarily something to be bought if it's breaking down through support levels and looks like it's rolling over. But some of the cyclical stocks, industrial stocks, energy stocks, they don't trade, in my experience, like growth stocks.
Right.
They're much more difficult to trade. They move up a lot, they crash, they break support levels, they base, they come back. So I don't treat them the same way as I would treat a growth stock in a way. And just from my experience, they've always been harder to trade. And lots of times, you know, precedents can come in handy. But like, for example, do you want me to mention a couple things that I've been doing?
Sure.
Okay, so
Let's
like,
get to it.
so I've been, over the past couple of days, I've been starting to build a position in Cleveland Cliffs.
Mm-hmm.
So so it had a great earnings report. Basically came right up to the high, I think, to the penny, and then it's come off about 15, 16%, and is sitting right on the 50-day moving average. So it does seem like the steel stocks are starting to firm up. Again, you can see kind of how, in a way, how ugly the chart is. I mean, in a sense, it's been in a primary uptrend, but it doesn't hold at the 50-day. It keeps breaking below, then going to new highs. And I mean, that's just the pattern. And that is what you're typically going to see in these types of stocks. They're not like the beautiful, nice little O'Neill growth stocks that hold at the 50-day line, you know, sometimes the entire way up to the ultimate peak. These are harder to trade. So I'm not buying them on strength. So if anything, I'm selling them on strength. So I'm taking this opportunity to kind of inch into something like this. The vast majority of my portfolio is in the O'Neill type stocks, growth stocks. But I am building positions in some of these more cyclical stocks that I think if the market's going to continue to move up, as I mentioned, I think there's going to be broader participation. And so I kind of like this. The Cleveland, you know, kind of came right up off the bottom, moved up very sharply on huge volume, pulled back on relatively lower volume. It's down at a support level. It's off 15, 16%. So it seems like a low risk entry point to me. So, you know, that's an example of something that I'm doing, kind of moving away from just the growth. I mean, you know, sometimes I get nervous when my entire portfolio is all in one sector.
Yeah.
You're diversifying in a way.
Yeah, exactly.
Mm-hmm.
Well, so Charles, so when you're starting to build your position in Cleveland Cliffs here, were you starting yesterday on November 2nd, or was it November 1st you started buying a little bit just to get on your radar?
Yeah.
How do you kind of, and I think that's always kind of the question that everyone has, like, you know, how does Charles start to buy these things as they're pulling back? Because obviously November 1st, it was looking really scary, and it's, especially for people who have been studying the system, that's a place where you're almost trained not to buy, because it's almost that trying to catch a falling knife.
Yeah, exactly. So I've talked about this in some workshops on how I buy pullbacks, or different methods of buying pullbacks. I am not afraid to buy something that does look like it's a falling knife, but I have learned to temper my enthusiasm, because my timing is typically pretty bad. So I believe my first buy was, I'd have to go check, but I think my first buy was 3 days ago.
Okay.
So yeah.
Which is November 1st.
And but I bought it small.
Okay.
So so it's kind of a reverse pyramid type thing, with the anticipation that it was going to come into the 21-day and probably the 50-day.
Mm-hmm.
So I think I got it. I put it in my portfolio on that day. Again, very small. I'd have to check, but it was, if I even bought it on the day, it would have been small. But the day after, I bought it in much more quantity. And today I continue to add to it.
Okay.
So now let's talk a little bit about risk management.
And by the way, I'm down on this. I'm down on the position.
Right.
I mean,
But that's something that you're kind of used to, and also sometimes being down a little bit before that turn happens, because a lot of times it seems like you really do have a line in the sand of, this is where I feel like it should come down to, and you might be buying a little bit early, you know, but you're still expecting it to come down to that level. In my experience of watching you. Now, at what point do you say, you know what, Cleveland Cliffs, this is now looking wrong? Is it, if it doesn't hold a 50-day moving average line, how much room do you give it? Is it one of those things where intraday, if it punctures it, do you give it until the end of the day or the end of the week to see if it can get back above that line? What do you do?
I'm a little bit slower than I mean, I've listened to some of your guests on IBD Live who are very precise and super disciplined. And I think it's probably the way to go, to be honest. I really almost want to discourage people from being like me, because
Like you.
I'm a little looser, and sometimes things get away from me, and I'm not as,
Well, it speaks to that flexibility.
yeah, I mean, I think it goes both ways. If you're going to be super precise and tight, you're going to get shaken out
Yeah.
a much higher percentage, but you're going to lose less on those
Mhm.
times when things actually do break open or get much worse. So I think you kind of can have it both ways. So I just checked actually. So I'm down 1.9% on this position.
Mhm.
So it's a small loss at the moment. And again, this is a relatively small position in my portfolio, which is dominated by, you know, stocks like Tesla and things that have really been working. So basically, I almost feel that I have so much cushion for the year, because I'm up a lot, that I can give these a little bit more room. But to answer your question, like, where do you draw the line? It should hold a 50-day at this point. I mean, today was some supporting action on a price basis. If it were to close below today's low, I'd probably reconsider. But again, it's not a huge position. I'm not down a lot on it. So I'm not overly concerned. I mean, sometimes I might just give it more space and say, you know what, you know, I'm down 2% now. If it falls another 2 or 3%, I'm just going to cut it and give it as much room as I can, because, you know, I think that, you know, with hopefully an infrastructure bill gets passed, the market's firming up, and maybe, you know, this is a stock that's clearly fundamentally had a great result that the market recognized, and it just gave the whole thing back. So, you know, I'm trying to take advantage of people that may have said, oh, it's about to break out, and they're buying it at 26, and now they're in kind of deep trouble, right? Because they're off, you know, 10 or 15%.
Right.
So I kind of try to take, that doesn't really sound very nice, but I'm trying to
let me have your
benefit.
shares.
Yeah, I mean, that's kind of where I'm stepping in and saying, okay, well, you know what, if you can't handle the pain, I'm going to take it off your hands. So that's in a way the kind of the point of swing trading and what I do. But again, I'm a little looser when it comes to actually executing on cutting the loss, and sometimes to my detriment. But on this particular stock right now, if it closes below today's low, I would say it's not really acting the way it should. It should hold around here.
And that's not really giving up that much.
No, I mean,
you know,
I'm not going to, unless it gaps down, it's not going to be, it's not going to be too bad. And if it, sometimes you encounter these kind of intraday shakeouts, and I almost always will wait till the end of the day before I take action. So I'm going to wait until this actually closes below today's low, likely before I cut a loss. But hopefully I won't have to. Hopefully the thing will start to move up. And I feel like I have my position. If the stock does start to move back up, I might buy a little bit more, kind of incrementally, but not a lot. I really don't want to buy on strength.
Right. Okay, when we come back, we're going to talk a little bit more about some of these precedents and how you've been handling some of your big growth names too. So stay tuned for that. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Welcome back, everyone, to the Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen, your host, along with 2 O'Neill portfolio managers from O'Neill Global Advisors. We've got Arusha Pierce, who joins me every week. And as our special guest, we have Charles Harris. So Charles, we were talking a little bit about the whole idea of how you're handling some of the stock on weakness. Arusha, do you got any ideas of some stocks we should talk about handling on the strength?
Yeah, well, I think we probably should go to the one that everyone wants to hear. It's Tesla. You know, this is obviously one of Charles's biggest winners this year. And Charles, let's get into how you've handled it this year and just walk us through some of the steps, just psychologically, of what you were seeing, and especially how you kept holding when you were starting to put up some of the bigger gains.
So I've mentioned this before at various, either on IBD Live or at various workshops. I'm treating Tesla differently than I've really ever treated a huge winner, because I really have true conviction that I think this is going to be a multi-year move, probably for the remainder of the decade. And I'm using
That's a lot
Apple,
of decade left.
Yes, and I'm using Apple as a precedent. And Apple is a stock that, let's say, started trading in 2004. And in 2004, 2005, made a ton of money in Apple. And then I start, and it went through a number of bases, and I never really got back on board in a huge way where I really sustained a long-term hold, never took a long-term capital gain out of Apple. And as well as I did, let's say the stock is up 70-fold or something in that time frame, and I certainly didn't make that kind of money on Apple. So I think Tesla's actually acting a lot stronger than Apple, and I personally think has much more potential and they have more levers. They have more end markets that I think they can dominate, that have a huge TAMS, total addressable market, and they are in the leadership position in many of them. So based on my experience with Apple, I am just so afraid of messing it up that I am really just trying to sit with my position. And I had a huge year last year, right? Truly a huge year that really was even better than the late 90s and the internet bubble. So,
which is hard to believe.
It is hard to believe.
Yeah.
I never thought I'd ever be able to repeat that kind of performance. So I am not really trading Tesla that much. It seems like whenever I sell it, it just goes higher. So, I mean, I have done a little bit of trimming into this remarkable rally we've had in the last 3 or 4 weeks. But so far, what I've trimmed, I've bought back higher. So I'm just kind of kicking myself, like, why are you trying to be so smart about it? The truth is, really the holy grail of trading is if you can really kind of do a pretty good job of picking off the tops and buying the pullbacks, your results would be incomparable. No one could touch you. And I think I'm a decent swing trader, but truthfully, I have not been able to figure out where to time the tops. I'm not that great at it. I almost always sell too early on the way up. So I have taken some profits on the way up. I've actually tried to recover most of what I've sold. I think all in all, I've sold maybe 5% of my position into this rally. So I've kept most of my position. And I was listening to an interview, a really interesting interview on a podcast. Actually, it's a YouTube channel. I think it's a podcast too. Dave Lee on investing is what it's called. Excellent. And he's great. He just has amazing interviews. And he was interviewing the 3rd largest individual holder of Tesla. And he's a billionaire. He owns millions and millions of shares. And he was commenting how near the bottom of the kind of COVID crash, he was nearly wiped out because he was on margin.
Right.
And he was like literally, almost almost down to nothing.
Wow.
And that really scared the hell out of me because I have a monster position in Tesla and I don't want to margin call if something crazy unexpected happens. So I did take the opportunity to take some profits into some of the strength. The stock has only gone higher, but I also had some, this is all with my personal account. Of course, I only talk about my personal, not the firm, but because I traded the stock very actively last year, I have some crazy cost basis stock because I keep running into the wash sale rule. So anyway, I have some very high price stock and I wanted to harvest those losses before year end. So that was kind of also my, the reason why I wanted to take something off the table. One, just to raise a little bit of cash, so I have a little bit of room in case things go sour, and to harvest my losses. So, but by and large, after my experience last year in Tesla, actively trading it the entire year and paying half my gains to the government for taxes, I really decided I'm only going for long-term capital gains if I can in this stock. So I'm pretty much hanging out with it. I have most of my position. It's been phenomenal, and it's really enabled me to take a little bit more risk in some of these other areas and maybe give some things a little bit more time that I might be down on but have conviction in, because this stock is masking all of those kind of losses.
Right. Now, just real quick though, to kind of get back to your Apple, precedent in a way where you don't want to mess this one up like Apple. Now, I remember you being in Apple, and I remember there was a point in time, I think it was in 2005, where Apple, like, for 6 months didn't do anything, and you were like, this took like 3 years off my life because you were watching Apple not do anything, and you're just like, you've got this big outsized position. You were trying to kind of change your methodology. You were trying to get a long-term capital gain out of it.
Yeah.
And, it finally ended up getting to new highs, but you're like, man, that was just, nerve wracking. So, Tesla just recently, it had a really long period of, topped at 900 and didn't get back there until just recently. And that was in February. So it was a long time of what you would normally call dead money. So how do you kind of, I guess, look at, both of those sides, and, what's your conclusion here? Is it better to have that dead money and just sit with it, or, what's your strategy?
I think that's a great question, and I've struggled with this now intensely for the past year and a half, trying to figure out what is the best strategy for building wealth, and particularly in a stock that you have real conviction in, that you really believe has a multi-year path of growth. I still swing trade all my other stocks and take short-term capital gains, but this one I'm treating differently. And after that Apple experience that you mentioned in 2005, I promised myself I would never sit through a base again. In fact, I'm actually using the 2005 and 2006 corrections in Apple as a precedent for what just happened here in Tesla. The problem is if you sit through, if you sell and try to get back in, one, your money might be deployed in other areas, and you typically never recover what you had. That's just in my experience.
Yeah.
So there's that risk of getting out and not being able to get completely back in to the extent that you were, because no one wants to buy the stock at new highs. At least I don't. I prefer to buy it actually when it's kind of coming off different areas and turning. I'm trying to buy a little bit earlier. So if I'm, by the time it's going through 900, like I would have hoped I would have been back in much sooner than that. But
right.
But when you take into account the capital gains, you really have to have phenomenal timing in order to overcome the tax disadvantage, particularly in a stock like this. So I am really held through the entire thing. I kept picking at it around the 200 day. I kept adding to my position. I mean, I have a monster gain in the stock from last year. I mean, I just did so well that even though by the end of the year I had sold it in my margin account, but I came back in, and I think we talked about this once, Justin, that even when I was down on the stock, because the stock fell 40%, all those gains that I had accumulated in the prior year, I mean, I still consider that cushion in my account. It's still kind of part of my net worth. So even if I was down on Tesla, I just have so much conviction that this is going to continue to go higher in the coming years, that I'm going to be really careful not to sell too much into strength. And if I do get these, very dramatic pullbacks that Tesla seems to have from time to time, in fact, I already have put limit orders in, 200 points lower than here. I'm just going to leave in there. And if they tick off, I'm going to buy it, because again, I'm treating this one a little bit different than most other stocks.
And what about, just to kind of back up a little bit on, how you got into this? Because again, we know now that it's a monster stock, but maybe you didn't know that at the beginning. So did you start this as an outsized position? Did you start it as a regular position and just add to it? Did you let basically the capital appreciation increase this position size for you? How did you handle that?
Okay, so Tesla was a stock that I traded very aggressively in 2013, 2014 timeframe, did really, really well in it. That was Tesla's first huge advance off of the long-term consolidation post-IPO. And then it had basically 5 years of...
And maybe you could show the monthly on this,
great.
Arusha, just so people can see that move.
So I got involved in 2013. That was my first big win in Tesla. And I was super bullish, and that was like, it dominated my account. I didn't expect it to pretty much go sideways for 5 years. And I got really chewed up during that time frame. I lost a lot of money. I traded options. It was just, my timing was terrible. And I really lost conviction in it. But by the time it finally got started again in late 2019, I bought it, and I just was like trading it like almost like it's short-term trading. Like it was moving up so quickly, and I'd buy it, I'd sell it. I wasn't trading it like a stock I had conviction in. And then I at the 2019 level 4 master's workshop, Jim Ropel, we were talking about it, and he said, watch this. He sent me this thing from Tony Seba. Tony Seba is kind of a futurist in a way, and sees kind of long-term trends and kind of disruptive technology is where he specializes. And I talked about this at a recent workshop, that it was so compelling. In fact, I think everyone who's listening, if they haven't watched the Tony Seba, SEBA presentation, it's on YouTube, on what is driving Tesla and all these technologies that are converging, that are allowing this kind of S-curve adoption of EVs and solar and AI, and all of these things are happening at the same time. And people will continue to underestimate how huge this growth is going to be. So once I saw that, it's like the light bulb went off, it clicked. And I just wanted to get as much of Tesla as I could. And thankfully it's been straight up pretty much. So yeah, I mean, I have just a tremendous conviction in it. And the thing is, people love to hate on Tesla. It's really kind of interesting that it seems like there's so many people that are negative on it. And whenever you listen to commentary, on CNBC or different analysts, people are always saying it's overvalued and how can they dominate, and they're worth more than every other car company combined, which is true. But I will recall that I made the same argument when Apple was moving up. Suddenly Apple had a market cap bigger than HP and Lenovo and IBM and Compaq Computer and all of them. And I thought, well, how can that be? It doesn't make any sense. And yet now Apple's a $2.5 trillion company, and many of those other companies are out of business. So, or have had to merge. So, so I've seen it happen firsthand, and I think the same thing is going to happen with Tesla. So I don't want to lose this one. So it's going, over the next, let's just pretend it does play out over a 10-year period. It's going to have 30, 40, 50% corrections. I mean, I've studied Apple very, very closely, and over the past 17-year move, beginning in 2004, there have been 10 corrections of 25% or greater. Okay. And I can't recall exactly, but I think there are about 3 between 25 and 30, 3 or 5 between 30 and 40, and a few but over 40%, and one over 50% during the 2008, massive bear market. So Tesla's going to go through corrections, but I think that it just has enormous potential in many categories. In some categories we don't even know about yet. They haven't maybe even been invented. I mean, they just came out with with their AI day and introduced the fact that they're going to come out with robots. Right. No one's even talking about that yet, but don't you think like that's the future? Yeah. And they're probably leading it already. So I don't know, man. I just don't want to mess it up. So the way I'm treating Tesla, that said, because it dominates my portfolio and it's been working, it's giving me a ton of extra buy power. I'm not just continually adding to Tesla though. I will on pullbacks, but I'm using that extra buy power to buy some of these other stocks that in different categories, almost like a little diversifier, as you mentioned, Justin. So the Cleveland Cliffs, I've been accumulating, it's still small compared to Tesla, but it's something. Right. I have a position in Palantir that's a decent size, but again, compared to Tesla, everything is small.
Well, go ahead and hold on to some of those thoughts. And when we come back, we'll take a look at some more of the stocks that are on Charles' radar. So stay tuned for that. KLNE, the Direction Daily Global Clean Energy Bull 2X shares, seeks to achieve 200% of the daily performance of the S&P Global Clean Energy Index. The S&P Global Clean Energy Index provides exposure to companies from developed markets whose economic fortunes are tied to the global clean energy business. KLNE allows traders to take a bold position in companies exposed to solar, wind, and other renewable energy sources. Okay, welcome back to the Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen, your host here, along with 2 O'Neill Global Advisor portfolio managers, my good buddy every week, Arusha Pires, and my good buddy from long ago, so even before you, Arusha, Charles Harris, portfolio manager at O'Neill Global Advisors. So a lot of great stuff on Tesla. Let's talk a little bit more about some of these other areas that you're looking into. And certainly, one of the things I've noticed and I've been talking about is, man, when I go to the beach here, Huntington Beach or Seal Beach, man, the line of shipping containers is big. I mean, I can just see them all out there. I took a flight and went out of Orange County, John Wayne, and I counted from my window seat 67 that I was able to count just from the air looking at these shipping containers. So
I hope you're on the window seat, Justin.
I was, yeah. Otherwise, that would have been awkward. Like, hey, guy. I mean, it's good that you have your mask on, but can you get your mouth off of mine? So, anyway, why don't you talk a little bit about this precedent that you're using with some of the shippers? And here again, you've been buying some of these on weakness. Again, very very different from what a lot of our buy points would normally be. So Charles, maybe you could share a little bit of how you're handling some of these shipping stocks.
Yeah, so I hate to, I don't want to kind of steer anyone wrong or too contrary to our system. So this is a little bit of a different play for me. I've talked in the past about my conviction in the shipping, particularly dry bulk shipping. And if I guess pull up Starbulk, SBLK. And so this has been a huge winner for me this year. It's continued to be, and I was using the precedent, kind of a technical precedent of the GOGL, which we can go to in a moment. But so on Starbulk, I've been trading it, and again, similar to Cleveland Cliffs, it's not, this type of stock typically is not going to hold at the 50-day and trade is a nice and uptrend and pattern as a growth stock. So I'm already aware of that. I already know kind of what to expect because I've seen former, when these stocks are in favor, I've seen how they act, and they never act in a nice, easy way. So I'm kind of prepared for that, and I'm expecting it. So last time I was on, Starbulk had fallen down, that 3-day kind of crash down to 20.
Yeah, right at the beginning of September.
Yeah, and I was buying it pretty aggressively, kind of coming into that based on
and I was calling it, hey, look at this failed breakout. Like if you bought at the breakout, like you got to get out of this. But then Charles comes on and he's like, oh, I'm buying this at the 50-day.
He's like, I'll take that off of you.
Well,
right, exactly.
But I mean, it worked. So I mean, but it could, maybe it wouldn't have worked. Like I've just been kind of trading this one well, and it's been working. But I also sold it on as it was moving back up.
Right.
So I mean, I certainly didn't top ticket, but let's just say I averaged somewhere around 24 on the way out, on the way up, and as it started to come back in, because my precedent indicated that it was going to come back into the 50-day. So after I sold Starbulk, I pivoted into a different one. I went into GOGL, which you showed, and all of the shippers, dry bulk shippers, pretty much are acting the same. This one's actually acting a little bit, well, you can see. I mean, it's worse than Starbulk in terms of the price performance. But this is the one that my precedent is based on. So, so before we go to the precedent, the reason why the shipping stocks, and particularly the dry bulk shippers, have gotten hammered so badly is the Baltic Dry Index, which was up maybe 75% in a couple of months, has literally fallen about 45% in the last 3 weeks. If you, so this is an ETF.
Yeah, BDRY is the ETF. Breakwave dry bulk ship is the ETF.
And you can see that the move was extreme on the way up. This doesn't perfectly mimic the dry bulk index, but for now, it's decent to kind of see what's been going on. And the thing's down 50% in 3 weeks. And so basically shipping rates have come in a lot, and the reason for that is from basically 15-year highs. And they were massively, like all of these shipping stocks are going to be massively profitable in Q3, which should be reported in the next few weeks. They're going to make a lot of money. They're going to probably raise their dividends, maybe do buybacks, pay off debt. I mentioned in Starbulk, I've received very significant dividends this year, and I don't buy stocks for dividends, but hey,
you're not going to say no.
If they're giving them away, then great. But in any event, this is an extremely volatile index, and as fast as it went up, it came down. And I think this is quite excessive, and I would not expect it to go much lower. I mean, the last time I've seen a break like this was late 2007, when the shipping stocks had their massive move and then all crashed, for over a decade. I think this is overdone, and the reason is, one, it's kind of seasonal. This is usually kind of a slower time in shipping, and China has been limiting because of the issues in their housing market and so forth. They've been limiting kind of iron ore for steel production. So, and of course, China's a big, really drives shipping rates in many ways. They're such a big importer. So, so dry bulk, dry bulk shippers ship grain, they ship kind of fertilizers, they ship iron ore, they ship coal. Those are the four main products that go on these ships. And iron ore has been out of favor and prices have been coming down because the demand for that has been going down. But coal, on the other hand, has been going up. And you know that coal competes with natural gas. And we know that natural gas prices are very, very high right now. So coal levels are kind of low. And so certain areas of the certain freight prices have actually held up pretty well, and others have gotten hurt. But I'm still constructive, to be honest, on the shipping stocks. And I've been, in fact, I initiated a pretty big position in Starbulk. I went back into it yesterday on the 200-day.
Mm-hmm.
And I have to say, I'm not hating the price action right now, man. I'm already up 5 or 6% on the position. And, but the GOGL, I'm actually down almost 9% on. But I also like the fact that we finally got support today, and to get support on a day where the BDRY was down 8%,
Yeah.
You may not have expected that. And all of them, if you pull up maybe DSX, that, they all kind of, this was all supporting action the past couple of days. So Justin, go back to GOGL and do a change date to 2005.
And I got to give Arusha credit. He's the one that's usually manning the ship, if you will,
Arusha, awesome.
on that. So I don't want to take credit for all his hard work.
So
thanks, Justin.
I've kind of changed my precedent a little bit, which normally I'd say is not a good sign to change your precedent mid-move. But originally, if you look at that peak at 36.
Okay, over there.
Yeah, I thought that first break in the current Starbulk, that was that break, that 3-day break.
Oh yeah, look at that.
And then it bounced up, and then it tested the 50-day again and went to new highs. That was what I was expecting to happen. And that's why I started to inch into the GOGL. Well, now I think I was just off. And now I think that break, actually, it looks much more similar on the chart, was that 39.25 peak.
Okay.
That 3-day break.
Yeah.
Was that you had your bounce up, and then you had that break all the way down exactly to the 200-day. You'll notice that that's about a 29% correction, which is exactly the correction of the current stock.
Wow.
So I don't know. Look, I don't know what's going to happen. You can just say, well, this doesn't mean anything. This is the past. But
Charles, how do you find precedents like this? And I think that's always been a question that I've had, because you always have found a way to find a interesting example or interesting precedent for some of the key stocks that you are in. How did you go through and find this and say, you know what, this part makes sense here?
Well, for this one, because I have a fundamental view and conviction in the dry bulk shipping recovery, and it isn't a massive recovery after, again,
10 years, 12 years.
Since 2000, this is really, like a 13-year,
right.
Correct, where these stocks went from
maybe just show real quick DSX, just show that on the monthly, just to kind of give people Oh, you know what? I'm sorry. I was looking at
What
a
about
different
Starbulk?
chart.
Oh no, if you do a change date back to current,
Oh,
you'll
wait a
see
minute.
DSX. We were
Yeah.
on.
Oh, there you go.
Yeah.
Oh, yeah.
Well, and yeah, here's Starbulk on a
So
monthly chart. Yeah.
Yeah.
and these stocks literally fell 99% plus.
Yeah. Wow.
So and I played them on the way up in 2007, 2008. So
Oh, I remember.
so I've been kind of waiting for a turnaround at some point, and we definitely are in the midst of a massive fundamental turnaround in these stocks. They're making lots of money, they're paying off debt, they're in very good financial shape. Their PE ratios are, 3 to 5. I mean, if you're making that much money, the amount of money you're making is going to be, almost equal to the market cap of the company. So, I mean, it's
Right.
I feel like they're not way overbought in any way, as far as this on a fundamental basis. But if you look at that again, that GOGL, we came off the 200-day, and 7 weeks later we were at new highs. I don't know if that's going to happen, but I'm positioned for that to happen, and I have pretty big exposure to God, I'm afraid to even say it. It's probably some guy gonna target me now, but I have a pretty
I'll show
big,
you.
I have a large position, and because my profits in Starbulk, just because I got in on the 200-day, have already offset a good portion of my losses on the GOGL site. I don't have, it's not like I have a huge loss. And again, I've got a lot of exposure in other areas that we normally play in. That's been working for me, and of course Tesla. So, so I'm in pretty good shape, but I'm hoping that this plays out the same way, and these stocks are going to report their dividends in the next few weeks, and I think they're going to move up. I mean, that's how I'm playing it, and as bad as the charts look, I'm expecting the 200-day to be an area of support.
That makes sense. And again, one of the things I really appreciate about some of the work that you do is you have made these kind of industry analysis, fundamental analysis on the industry. I remember not too long ago, the home builders. Well, I guess it is long ago now. That was over 10 years ago, I guess, at this point.
2011, exactly 2 years ago is when that recovery began.
Right.
Wow.
Yeah. So,
and that was a big plan. I'm kind of, as actually, this is completely based on that. That housing recovery was about a 2-year recovery before they stopped, before they really played out. And so I'm kind of treating the shipping as a current type of thing.
Did we answer the question though? How do you find these? Because Arusha asked, I think, a very good question. We got off track a little bit.
So
I want to make sure we get the answer to this one.
Yeah. Well, okay. In particular with this one specifically, because the dry bulk index has had such a massive run off the lows, I went back at the history of the dry bulk index and looked for periods where it had a similar type massive move in that time frame, and it brought me back to this time frame of 2005, 2006.
Okay.
So once I did that, I went back to see, well, were there any shippers that are still in our database that were trading in that time? GOGL was actually the only one that I found that actually was trading in that time. I guess there are other ones went out of business or merged. So I looked to see how GOGL acted during that massive run, and that's my precedent. So that's how I found this one.
That's excellent.
I do also have kind of notebooks of precedents and runs that, when you've been trading a long time and it's all you do all day is look at charts, you just kind of I have a terrible memory for pretty much everything else, but I have a good memory for charts. And a lot of times,
and just so people understand, when you say notebooks, what you really mean is binders.
Binders, binders.
Binders. I want people to get the picture. Your office has like binders filled with these, these papers marked up exactly as you have, where you're, counting days sometimes, counting.
That's exactly what I'm doing. In fact, this is GOGL. This is what I did this is when I kind of didn't adjust it yet, but you can see I wrote on there precedent for SBLK.
Oh,
I put on the amount of the move off the low. This is what I do. I have binders full of
Binders
these,
filled with those.
and I have them categorized into different types, you know, pullbacks to the 50, pullbacks to the 200-day, kind of breakout shakeouts and what happened, gap ups. I mean, I have all these kind of technical precedents, and particularly the ones that you've traded and made money on, those just stay imprinted on your mind. So in a sense, I might have hundreds and hundreds of precedents, but I keep coming back to the same 20 because those are the ones that are always on top of mind. But yeah, and that's what I do. And I think you have to be a little bit careful though, because the precedent is not a guarantee.
You have to know when it's no longer following the precedent.
And I will say that probably my biggest winners and where I really killed it in the market were due to precedents, and some of my biggest losses are also due to precedents because I did not pay attention to the fact that they no longer were working, and there's no reason why they have to work. So you know, you kind of use it as a way to gauge your expectations, and once your expectations are broken, you have to start to move away. So
and that gets back to that whole flexibility idea that we talked about. So
exactly.
Well, Charles, I really want to thank you for coming on and sharing some of your experiences with your winners and the things that you have on your radar. It was really great having you on, and always a pleasure talking to you. And just a reminder for folks, you will be on IBD Live on Friday morning. It's always a good thing to be watching Charles during the market hours, and we talk about, you know, what's on his radar and what he's seeing at the moment, and get a lot of great analysis. So if you haven't joined us before, maybe go to investors.com/IBD Live, because it is a great time. So thanks again, Charles, for coming on. And next week we are going to have Scott Bennett on the show. He's returning. This is someone that Arusha, you had on before, right? Yeah, so it's going to be great.
Pre-Justin years.
The pre-Justin years. It's going to be great to catch up with him. He's the founder of investwithrules.com. So hope you join us for that. And thanks for joining us today. And we'll see you next time. Bye-bye now. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.